And we're back. Welcome back to Retirement Decoded, the podcast. I'm your host, Scott Tucker, and with me is Associate Advisor
Matt Mirabella.
With the robot cameras going back and forth. We had these voice-activated robot cameras. You can see them at tuckeryoutube.com. Now, you're welcome to always listen to the podcast, Apple Podcasts, Spotify, I think Amazon, iHeart, podcasts all over the place. And but also YouTube is taking over the podcasting world, so we're also in video format for the podcast at tuckeryoutube.com. I should mention before we get too far along, if you'd like to talk to us, want to talk to one of our financial planners over the telephone or whatnot, we'll say telephone, the easiest format there is. If you go to tuckerretirement.com, now it's down below in the description, or you can just type in tuckerretirement.com. You can see our phone calendar, click and pick a time that works for you. We'll spend 15 minutes for free with you over the telephone in the coming week with one of our financial planners. We'll get your financial planning questions answered, Matt.
And your questions answered.
At tuckerretirement.com. And today's question for the podcast, on that tuckerretirement.com, if it's appropriate or we get down the way a little bit, we can always give you a Zoom link and you can see our screen and we can punch in your numbers so you can see your future all charted out in color for the comfort of your own home or your workplace, whatever you want to do. So here we are with episode 88, of course, and today's question comes from Karen. She lives in Glenview in the Glen. So Glenview, there used to be a naval air station there, and they tore it down and they built a subdivision. And hopefully the Soviets, that was in the Soviet Union fall. So we figured, why do we have a naval air station in Glenview, Illinois, when we could have a ritzy subdivision? And we've got other naval air stations. And so we developed it. So Karen from the Glen says, Matt, my husband and I have saved well for retirement, but nearly all of our money is in traditional IRAs. How concerned should we be about required minimum distributions creating a huge tax problem later? What do you think about that, Matt? Now, we don't know her age.
Well, and not knowing her age, but it sounds like there's already a little bit of concern. She mentions a huge tax problem.
Yeah.
So it sounds like there's a little bit of concern. Looking forward to that, but I would look at planning sooner than later. Again, not sure of her age, but more appropriate to start looking sooner than later.
Yeah. So Karen and her husband. Oh, this would be a great time for me to remind folks we do help same-sex couples, but here we are, Karen and her husband. They've saved well for retirement. Now, they don't say how well that is either, because I want to caution folks there too. There used to be a commercial for, before Voya was Voya, it was ING, and there was a time where the Dutch government, because that's International Netherlands Group, but in Dutch, it's like International Netherlands Group.
Something that's hard to pronounce.
Yeah, but it was like it was International Netherlands Group, and almost a direct translation. It wasn't, unlike some Dutch, it actually made sense. You could look at it and say, oh, that's International Netherlands Group. So there used to be ING of America or ING USA or something, and then there got to be a thing after 2008 that the Dutch government said, some of the American version of ING is doing some wild stuff. We don't want to be associated with that anymore, because it was like a royal bank almost. And the national color for the Netherlands is orange. So you may have seen a lot of ING stuff in orange. And even today you see a lot of the Voya stuff in orange. So this is our history lesson, Matthew. So back, it's almost 18 years ago, 2008. Yeah. So back then, after the whole 2008 shakeout, the Dutch government said, what we want to do is we want to sell off all the non-Dutch stuff, like the American stuff. The Americans are crazy. So, the world views the Canadians as the non-crazy version of the Americans. So our northern friends in Canada, they're the slightly less crazy, less gun rights, more socialist, more free healthcare. The rest of the Western Europeans look at them as being the sane version of the North Americans. And then the Americans, though, we get going on some stuff like 2008 vibe, and we might be doing it again with all these IPOs and things. But back in the day, there used to be these commercials for ING, and before it was Voya, in the U.S., and they would have these people walking around with the numbers under their arms. Do you ever remember that? That was a long time ago. And people would walk around with these numbers, like kind of these cutout numbers under their arms. And the idea that the back then, now this is almost 20 years ago, the idea was that if you got to $1 million, now there's your magic number. If you have $1 million saved for retirement, you'll have no problems. And back then it used to seem kind of like that might be the case. But all these years of higher inflation, and even back when we had inflation during COVID, there was a year that we got 9% inflation. So the cost of everything went up 9% in a year. It never went back down. It stopped going up at 9%, and then maybe it was like 4 or 5%, and then 3%. Now it's back to 4.2%, something like that. That range anyway, between 4 and 5 right now. But once you get a few of those compounding inflationary years, like you throw a 9 in there, that kind of hurts.
Yeah, that's quite the wrench to throw in there.
So my husband, Karen in Glenview in the Glen, she says, my husband and I have saved well for retirement. That's what caused me to think of that. Saved well for retirement. We have a lot of people that we talk to. We talked to somebody just the other day that had $800,000 saved for retirement, and they still owed $50,000 on the house. $50,000 on the house, not a big deal, but $800,000 saved for retirement. All of it, or $600 of it was in tax deferred retirement accounts. So we start thinking about, is $1 million saved for retirement a lot of money? Now in Glenview, I would not be surprised if Karen and her husband had 2 or 3 or more, 4 or so million saved for retirement. Glenview, I would tend to think a lot of people are right around the people that we run into, because we run into odd ducks, right? Most people that come to us have saved something for retirement more than most Americans have. Now we do help people that have saved $250,000 for retirement, but we are seeing, I would say right now we're seeing more and more and more people, just everyday people between 1 and 3 million. And a lot of folks well above 3 million, and it's kind of strange.
Yeah, I feel like recently we've seen that, like you said, 1 to 3 really take a tick up, and even some of those, people who are closer to like the 3 or 5 area too.
And I don't want to discourage anybody from getting on our phone calendar, tuckerretirement.com, but the 3 million, so the 1 to 3 million is now, this is strange to me as a everyday, grew up, my mom was a nurse, my dad was a carpenter, and a lot of the average-ish people that walk through our doors anymore are 1 to 3 million, save for retirement, excluding real estate, and they have a paid-off house too for maybe 700. But we're getting a lot of people at 4 million, 5 million. I remember when it used to be an outlier. We had a lady years ago from a Social Security workshop. This is pre-COVID, I think, 14 million. And I used to think, wow, that's something we don't usually get that at a Social Security workshop. Somebody with 14 million, and she wants to make sure she's getting every last little bit she can get. Then we just recently had a couple come see us with with$15 million, and they're only about 60, kind of youngish on our spectrum. And we had somebody else come see us with 30 million net worth. So, and we had somebody back off the TV appearance that I do with WGN9. Up in, I would say, was it Lincolnshire, 20 million?
Yeah.
And they're just regular people. The gentleman with the 20 million, he and his wife, she has a little self-employed business where she makes 100 something net profit, and he has a job managing something for a big company that I won't name, and he makes like 160,000. They didn't inherit anything, and then they're like, oh wait, we got a problem. They're like 62 with net worth of 20 million and like 16 million investable and 8 million in IRA and 401k. This is wild. So anyway, then that might make Karen and Glenview not feel so special anymore. My husband and I have saved well for retirement. So saving well for retirement, I don't know. I would think she's probably 2 or 3 million. I'm trying to guess. But nearly all of our money is in traditional IRAs. Now, this is a problem. It's great that you have it saved in traditional IRAs, but the problem is it's not all your money.
Right, you have someone there on your side.
Mm-hmm. Yeah, I mean, you might have saved $4 million in IRAs, and it might be that the IRS thinks $1 million of it's theirs. And then the taxable nature of IRAs in the future can cause, let's talk about if you had $1 million traditional IRA, which is a great accomplishment. I'm not trying to poo-poo it. I'm just thinking it's really weird how these, we've had a run up in the stock market for about 17 years now, since 2009 to 2026, 17 years. And the market's pretty much gone in one direction. I computed it the other day, and I want to say that the market's up 4.5 times in those years. I'd have to double check that. There's a lot of weird numbers when I'm looking at charts and calculating these things. It's like, wow, it's really gone up sharply. And it's really helped people a lot. But again, cost of everything else gone up too. But anyway, yeah, stock market's done really well, which it doesn't always go up. Do you know that, Matt? The stock market doesn't always go up.
I do know that.
Not everybody knows that. A lot of people are like, hey, SpaceX, how can I get in on it?
Well, it's interesting. Some of those IPOs, people are thinking it's just, oh, it's this big company. It's going to go up. And
Yeah, everybody else is doing it.
yeah.
The SpaceX IPO, SpaceX was offered at $135 a share. It was offered at 110 times gross revenue, not profit, 110 times gross revenue. In the launch business, in 22 years, has always lost money. I mean, it's always lost money. Let me in. Life savings, here it goes.
It's a shiny object.
Put it all in black. Let's spin that wheel.
That's one way to think about it.
It's a shiny object. That's right. My husband and I, Karen in the Glen in Glenview, my husband and I have saved well for retirement, but nearly all our money is in traditional IRAs. So it's not all yours. Some of it's Uncle Sam's. How concerned should we be about required minimum distributions, creating a huge tax problem later? So I'm kind of in the tea leaves. The RMD age now is different for everybody, it seems. But right now we're running into a lot of people that are asking about this where their RMD age is 73. For other folks, RMD age used to be 70 and a half, then it was 72. Now it's 73, and some folks will be 74, 75. And so right now it's somewhere between. We have a lot of folks asking right now that their RMD age is going to be 73. And the RMDs, the required minimum distributions themselves, that's not the whole problem, is it, Matt?
No, it's some of the other burdens, we'll say, that would come with taking those RMDs.
Well, because Karen, you and your husband, you've saved well for retirement, but nearly all your money's in traditional IRAs. So you're gonna take money out of the traditional IRAs just to pay bills, and that's going to be federally taxable, and it's going to cause taxable income that could cause up to 85% of your Social Security to be federally taxable. So a lot of folks in Illinois, we help folks all across the country, federally licensed, but a lot of folks in Illinois think that because Illinois doesn't tax Social Security, that the IRS doesn't. And that's not how it works. The IRS may not tax Social Security if you have your affairs structured properly. So get on our phone calendar at tuckerretirement.com, and we'll spend 15 minutes for free over the telephone. We'll talk about how we could potentially do that for you. But yeah, the IRS can tax up to 85% of your Social Security. And that happens when you go into retirement with all your money or almost all your money saved and tax deferred, like you have now traditional IRA. Now, all is not hopeless. All is not lost. Now, we could potentially move some things around, not just Roth conversions. We might look at Section 7702 conversions and other tax maneuvers. The Internal Revenue Code has 1,700 incentives in it. We use about 100 of those regularly, and there are 5 core that we use the most. But we don't just use Roth conversions. So if that's all you're getting right now from your own ideas or from your current advisor, if you have one, then we ought to talk. Get on our phone calendar at tuckerretirement.com. Distributions from IRAs, whether used just for you to live on, that can cause Medicare high income penalties. There was something I saw recently too. There are these Facebook groups where people ask advice of one another.
Oh no,
about retirement. You had to get in on these Facebook groups just to be a fly in the wall.
I was gonna say, I think it'd be interesting to be there. Like, I'm just gonna look from a bird's eye view.
I know there are some other licensed financial planners that are in there just to voyeuristically see what's going on. And once in a while, one of the financial planners comes to the rescue, like, da, 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 da. There was somebody the other day, and they were so enthusiastic that they were so smart, and they had it all figured out. They're like, I know what I am doing. I'm putting $1 million of non-qualified money in municipal bonds, and I'm going to have safe, free, tax-free returns. It's like, okay, listen, bonds are not safe. There's default risk. If you don't believe me, ask folks in the state of Michigan that owned bonds from the city of Detroit. 20 years ago or so, the city of Detroit went bankrupt. They went through federal bankruptcy court. They discharged all those bondholders. So bonds are never safe. Not only because there's default risk, there's also interest rate risk. If interest rates go up, the value of your bonds goes down. There's also inflation risk. What if you lock in right now with a municipal bond at, I don't know, I'm just going to pull a number out of my back office. Say you get a municipal bond paying 4% right now, and you go, well, I'm not paying any federal income tax. Well, what if inflation goes up to, like it was recently, 9% a couple of years ago, and here you are making 4% tax-free. I don't care if it's tax-free, and now I can't go find a way to I got to go sell my bonds at a discount because now interest rates went up. As inflation went up, interest rates would have to go up too. The Fed would raise rates. Now you have to fire sale your bonds and then try to go find that 9% somewhere. So it would really be tough. The other thing, there's another thing. Oh, your Social Security. tax exempt interest from your muni bonds has to be declared on line 2A of your federal 1040. That goes into a formula called provisional income that's not explained in your 1040 that can cause up to 85% of your Social Security to be federally taxable, and you'll find that on line 6B of your 1040. So muni bonds aren't safe. They have default risk. They have inflation rate risk. They have inflation risk. They also can cause up to 85% of your Social Security to become federally taxable, even when you're not working. Sounds pretty good, though. Matt, you want to buy some muni bonds?
Why not?
The other thing about muni bonds, so Matt, you're familiar with the phrase markets are efficient.
Mm-hmm.
Well, muni bonds, the yield is always lower than on taxable bonds because everybody flocks to muni bonds, so it drives down the yield. People overpay for muni bonds, so it drives down the yield. So even though it's tax-free yield, you've got to calculate if I had a taxable bond and an A-rated something that's unlikely to fail. Like a corporation that's unlikely to go bankrupt. It's super duper strong, a super duper A-rated plus. If you got a bond from a high grade commercial entity that's is every bit as stable as the city of Chicago, no, more stable than the city of Chicago, right? So if you got instead of a muni bond, just because it's tax free, if you went and got a taxable bond, if you wanted to be in bonds from a very creditworthy municipality or tollway or state government or whatnot, those yields are higher on those taxable bonds. They're quite low yields on the muni bonds, and because people chase them, the muni bonds because they're tax free. But again, the tax free interest for muni bonds, it has to be declared to the IRS, but the IRS already knows that they're just seeing if you're going to fuss up on line 2A or 1040, and the tax exempt interest can cause up to 85% of your Social Security to be federally taxable. That started back in. Now I'm thinking about the muni bond part. The part about Social Security being federally taxable started back in '83 when Speaker of the House Tip O'Neill, a drunken Irishman, Democrat from Boston, which is fine, fun people. He was Speaker of the House, and then another drunken Irishman from Illinois, Ronald Reagan. No, they got together, and back when politicians used to compromise. They had to make a compromise or else Social Security was going to go belly up. And so they made a number of changes. They made the full retirement age older for folks, younger folks. So instead of being 65, they moved it back to 67 over a number of years based upon your date of birth. They haven't done that since '83, so it's due to happen again to save the system. Back in 1993, during President Clinton's administration, there was a change as well. So in '83, they made it so some folks would pay federal income tax on up to 50% of their Social Security. And in 1993, under the Clinton administration, whoever was in charge of Congress then, I believe it was Democrats then in '93. Because I remember Newt Gingrich came along in '94 and changed the Republican, kind of Republican, a red wave. They took over in '95. But in '93, during the Clinton administration, there was a change where they made up to 85% of your Social Security federally taxable. And so, how do you find out now that how do you end up now having up to 85% of your Social Security federally taxable? One way to do it is to have too much tax exempt interest from muni bonds. What do you think about that, Matt? All your money in muni bonds?
That's one strategy. I do think it's interesting. A lot of folks who come and see us not knowing that they're actually getting up to that 85% taxed.
Oh boy. They find out after the fact.
Yeah, they're finding out the hard way.
They're finding out. We have folks all the time that they try to do their tax planning on April 14th, right? Then they go, I saw my accountant, and then I did that. Well, yeah, the year's already over. When you go see your accountant in February, March, April, trying to fix last year's issues, there's really not much they can do. They can tell you if you're self-employed, go buy a new pickup. Not great advice. They can tell you if you're self-employed, but put a big chunk in your SEP IRA. Yeah, all right. It's sort of not really tax planning. It's like Band-Aids. It's a big ball of Band-Aids. What else they can say? Oh, you know what? Put some money in your traditional IRA. I mean, they can only tell you so much, and that advice is just kind of ho-hum, not so great. Unfortunately, the CPAs that do tax return preparation, the CPAs and enrolled agents, consumers have jerked them around so much and judged them for the wrong things that they are not financial planners or tax return preparers. I know there are CPAs that do other things. There's forensic accounting, there's audit, there's all these things. But the accountants that are operating in the world of tax return preparation, the consumer has screwed it all up. Drop off my W-2s and everything on like February 1st. Now they're probably uploading them, right? Uploading them to there's software like TaxDome and things. So they're uploading their W-2s, all their tax forms on February 1st. How Mr. CPA or Mrs. Enrolled Agent or Ms. Enrolled Agent or enrolled folk, how quickly can you get my returns done? How little can I pay for my returns? And what's the biggest refund? Those are dumb questions.
It's the only thing that matters at that point for some people.
Yeah. Really, you ought to be doing your tax planning for this tax year during this tax year with meetings with your CPA throughout the year. And because some of the things you can't do at the end of past New Year's Eve, right? Into New Year's Day. So you ought to be having the tax planning meetings during the year. And also, even though you've done the tax planning meetings during the year, you likely ought to be filing for an extension and not trying to file for April 15th. You ought to be paying what you think you owe, not accounting advice, tax advice, or anything like that. You ought to be paying what you think you owe by April 15th. But you should probably be filing an extension. Let your accountant go on. You've noticed all these accountants, they all go on a cruise on like April 16th.
Yeah, it's very weird.
Are they all in the same ship?
They might be third or fourth week of April. It's all of a sudden like no one's in office.
Yeah. So I don't blame them because of the way their business is set up, which is a horrible business model. But so like February, March, first half of April, and then April 15th, April 16th, usually a lot of accountants go on vacation for a couple of weeks. Hey, well deserved. If you're going to work evenings, weekends, and grind it out, hey, have fun with that. And if you live through it, then you should go on a cruise, I suppose. But we ought to not be doing our tax planning, at the last minute like that. Things are already I would say half baked. They're fully baked.
At that point,
there's not a lot you can do at the end of the deal there. So, Karen from the Glen in Glenview, nearly all your money is in tax deferred accounts. Yeah, you should be concerned about required minimum distributions, but you ought to be concerned about more than that. You have a bigger issue than that. So get in our phone counter down below in the description at tuckerretirement.com, or just type in tuckerretirement.com in your little address bar in your browser, and we'll get you on the phone calendar 15 minutes for free in the coming week with one of our financial planners. Matt, as always, we'll get your financial planning questions answered, Dan.
Your questions answered.
And your questions answered. Well, it's been fun. It's been real. We'll talk to you next Monday morning on the next episode of the podcast. Thanks so much.